Hey guys, so we're going into long-term solvency ratio. So after we are confident that we can take care of our bills that are going to be due within the year, we cannot be irresponsible business owners, you and I being a partnership. We have to actually understand and start planning, start forecasting, start having an idea of what the future is going to bring. So that's where our long-term solvency ratios come into play. And one of them, a key ratio, is going to be your total debt to total assets ratio. It's very simple. You go on your balance sheet, okay, and you take a look at all your debts and you add them up. Take a look at all your assets, you add them up, you divide total debt over total assets. Everything I owe, all the amount of money I owe, and the financial value of everything that I actually have. All right, so your intangible assets, your tangible assets, your long-term, your short-term, put them all together, and what is that value? So how would this look? It's one of the easier ones to calculate, and actually one of the easier ones to rationalize. Why do I have such a tough time with markers? Okay, so we would look at our total debt, and let's say we're being a little irresponsible first. All right, just because I believe it's easier for you to have more of a passionate reaction to things that are very well disciplined. So let's say we owe $90,000. We just started. Okay, it's been a month running our company. We already owe $90,000, and as a total, we only have $100,000 worth of assets. What does this mean? If we went bankrupt and had to liquidate everything, hopefully, if we were compensated what we believe is the value of everything that we have, all right, yes, we'd be able to pay off our $90,000, but reasonably, what are the chances that we're going to get the exact amount back? All right, we may have already used some and people don't want to pay for that used good. All right, so let's hope we're able to actually sustain the business, because now we know, especially with this high amount, like with how close these amounts are, there's a lot of pressure on us to actually turn up a profit on period to period basis. But let's take a look at the calculation, and we'll just go over how we feel about what these numbers are telling us. Okay, so we'll take out 4 zeros here, we'll take out 4 zeros on the bottom. All right, an irresponsible, and I don't want to say irresponsible company, because again, I really like to emphasize in finance, when you're looking at ratios, it really depends on your philosophy, your strategy, your industry, and what your competition is doing. You can never ever ignore that. A textbook can tell you, okay, this is our goal for this ratio, but it doesn't really mean much, because I don't know, a deli is not the same thing as a hedge fund. That's actually probably the way I'm going to start describing it from here on out, especially when we talk about leverage. Okay, so let's get back into this. What is this ratio telling us? So in ratio form, which is easier for us to have a conversation about, it means for every $10 value we have as a company, we owe $9. All right, in decimal form, the answer is 0.9. So 0.9 of everything we have, well, 90% I should say, we'll just say 90% here. We're getting fancy with our numbers. 90% of everything we have is causing us to owe some money. Okay, so just look at the words. Look at the words and think of how we've been describing the words. All right, in the beginning of the series, I said business is easy. Most of the things that you need to know are right in front of you. They tell you what they are trying to describe. So debt to assets ratio is just, if we take a look at all our assets, how much of it is debt? All right, and we already know where we're supposed to get the total debt and total assets from. So I personally don't feel comfortable running a business with 90% of our assets or our financial resources, causing us to owe so much money, or being exactly what we owe, I should say. I just don't. It's just, you can argue a point and you can say, hey, you know what? Well, at least we're not using our own money. We're still able to keep our bank account safe, and we don't have to put in our own capital. But then I'll argue with you, we're putting so much pressure on ourselves and our operations that we need to turn a profit. If any single slip up, and we're going to go bust. We're going to make a lot of people panic. Our debtors are going to be worried and want to take us to court, because they don't think we're going to be able to turn a profit. They think there's going to be too much pressure on us. They think we're going to start falling behind on our bills. So 90% debt to asset ratio, I'd be concerned. You may not be concerned, or you may be concerned and I'm not. I mean, it is what it is. But just have an idea of what's actually going on with these ratios. So let's look at one that may be healthier for the both of us. So what does this tell you? Okay, because the key here is for you to understand what's going on. Debt to asset ratio. Debt is 60,000 and assets 100,000. It means we have $100,000 worth of stuff and we owe $60,000. I feel more comfortable with this. Okay, so after we do all our math, we realize that we're looking at I should do the math because I'm not good at doing this stuff in my mind. So we're looking at 3, I should say. I'm sorry, 3 to 5, and that's still 0.6, which is 60%. Okay, and again, there's no right or wrong. There's just brilliant strategy versus bad strategy. Okay, so if we look at everything that we have and we say, as a result of everything we have, we owe $60,000 and we only have $100,000 worth of stuff, that's not that bad. Not in my opinion. For a startup, we plan on actually getting the word of mouth out there. We know we're going to be successful. We know we're going to be able to deliver a lot of value to our community. People are going to trust us. We know we're probably not going to have to borrow any more money for a very long time. It depends on the situation that your company finds itself in. Okay, so but there's one other cool thing about the debt to asset ratio that I did want to mention, and that is if you know the total for your debts and the total for your assets, you're able to easily find the equity of your company as well. So that would just be, let's take the example 60,000. We'll say that's our liability. Might as well finish the whole thing. We'll say 100,000 is the value of our assets. All right. So as a result of having $100,000 worth of stuff, we owe $60,000. If I have not emphasized that enough. And you're able to find your equity. Why are you able to find your equity? Because we understand that our assets equals liabilities plus equity. So that means to find our equity, it will just be assets minus liability. And in this case, that would give us $40,000. So I just thought that was something cool to point out. So in case you want to impress someone, and you're talking about your debt to asset ratio, you can kind of say, hey, you know what? Well, because our liability is this. I mean, if you're having a conversation on a sophisticated level, I'm sure the other person you're speaking to is already going to have an understanding. But if you have a point to make that relates to equity, it's very easy for you to bring into the conversation. All right. If you understand that your debt to asset ratio is 60%, well, your equity to asset ratio is going to be 40% as a result, and you can flip the conversation that way. All right. What else do I want to bring up? Yeah, I mean, it's very self-explanatory in the sense that once you look at what the ratio is, debt to asset, you know already what's going on here. You know it's how much you owe as a result of everything you have. All right, and we're trying to understand leverage. We're trying to find the right ratios that point us in the right direction of whatever questions we have. Okay, if we already know we have the right questions and we're trying to form the proper strategies, and we need to know, okay, well, for this month, for this period, I should say, we are leveraged at debt to asset ratio of 0.9 or 9 to 10. The next period we're aiming for, it's that's how you start to have a well-rounded conversation, at least with yourself and within your company. That's how you start developing strategies. All right. So long-term solvency ratios, the first one we've talked about is your debt to asset ratio. We also spoke about how you're able to find your equity to asset ratio, and really it's just about understanding financial leverage, developing our business acumen, and being very comfortable with all of it. Thank you.